The next section on market risk talks about volatility smiles. So let's first understand the concept of implied volatility. So we studied in FRM part 1 that the price of a call option can be given by the Black-Scholes model as SND1 minus K e raised to power minus RT in D2. That is, essentially, if we know the spot price, if we know the strike price, we know the risk-free rate of interest, we know the time to maturity, and we know the volatility of the stock or the currency, then we can input all these factors into the Black-Scholes formula and compute the price of the call option. Similarly, we can easily derive the formula for a European put option using the Black-Scholes-Merton model. We will input the same spot, strike, risk-free rate, time and volatility of the stock, and we can derive the price of the put option. Now let's say that we were given the price of the call option and we were given the price of the put option. So they are trading in the market. The premium or the value of a call option is known. The premium or the value of a put option is also known. In such a case, can we input these known values of the call and put option, further input the spot price, strike price, risk-free rate and the time to maturity, and then compute the implied volatility from the equation? It's still one equation, so one variable can be derived. So when we input the price of the call option or we input the value of the put option and then calculate the volatility from the Black-Scholes-Merton model, that volatility is referred to as implied volatility. Now please tell me that intuitively, whether you derive this implied volatility from the price of the put option or you derive the value of this implied volatility from the price of the call option, should it come out to be the same or not? Yes? Similarly, if you are valuing an option at a strike price of 10 or if you are valuing an option at a strike price of 15, will you enter a different volatility to compute the price of that option? No, the volatility of the stock is whatever is the volatility of the stock, calculated historically or whatever method. So, regardless of the stock price, you would enter the same volatility. So, would you not expect that when you compute the implied volatility from the prices of options with a strike price of 10 or with the strike price of 15, the implied volatility should come out to be the same? Yes. However, many a times in the real world, we've seen that this does not happen to be so. We can also prove that the put-call parity theoretically indicates that the deviation between the market prices and Black-Scholes-Merton prices will be equivalent for calls and puts. Hence, implied volatility should be the same for calls and puts. So we derived the put call parity, that is C minus P is equal to S minus K raised to power minus RT. So if C is the Black-Scholes-Merton and P is the Black-Scholes-Merton, or if C is the market and P is the market, even though Black-Scholes-Merton may be mispricing, but it will misprice the call and the put equally, because the put call parity is a no arbitrage relationship. Hence, the deviation in market prices between calls and puts, that is C of BSM from equation 1 and 2, we can derive that C of BSM minus C of, or rather minus C of market should be equal to the P, or the price of a put option from the Black-Scholes model, minus the price of the put option from the market. Again, you don't need to go deep into what this is saying. It basically is saying what we just understood intuitively also, that the implied volatility should theoretically come out to be the same whether you derive it from the price of a call option or you derive it from the price of a put option. However, many a times we've seen in the real world that the implied volatility, when we calculate from the prices of options, does not come out to be constant across maturities and across strike prices. Now we'll understand this in the context of various asset classes. For currencies particularly, we've seen that the implied volatility exhibits a smile as depicted in the figure below. That is, the volatility pattern used by traders to price currency options generates implied volatilities that are higher for deep in the money and deep out of the money options as compared to the implied volatility for at the money options. So for at the money options, comparatively, we've seen the prices are lower, or the implied volatility comes out to be lower. If we use the same implied volatility assumption and computed the price of deep in the money options or deep out of the money options, call or put options, then the price would have actually come out to be lower if we use the same implied volatility as an at the money option. But we see actually the prices are, traded market prices are higher than what would have been given by this implied volatility. Or in other words, we can say that the volatility implied by the market prices is higher than the volatility implied by at the money options. So what we're essentially saying is that in options, we have assumed, or rather we have noticed, we have observed that traders generally are scared of extreme movements. So if they are writing, that is, if they are selling a deep out of the money option or deep in the money option, then they are not pricing it like the Black-Scholes-Merton model. That is, they are not following a log normal distribution in their pricing. What is the Black-Scholes model eventually? It assumes that stock prices will follow the log normal model. We've seen in the real world also that this assumption can be violated. That is, extreme movements are more likely than predicted by the normal or the log normal model. And that is reflected in the currency smiles. That is, extreme up moves and extreme down moves, the option traders will write, they will give you the option, but they will charge a higher price, essentially implying that these extreme movements are more likely than what is given by a log normal distribution. So just understand that implied volatility in currencies exhibits a smile, that is deep in the money and deep out of the money options have higher prices or higher implied volatilities than given by the Black-Scholes-Merton model, indicating that traders fear that extreme movements may be more likely. In the case of equity options, the volatility smile exhibited is more of a smirk. That is, for lower strike prices, the implied volatility comes out to be higher. So, this fact has been attributed to the fear of leverage and crashophobia. So, if I am writing a put option at a very low strike price, then I don't charge a low price, I charge a higher price, or I indicate a higher implied volatility, because again the market participants are fearful of a crash, because they have seen so many crises, the global financial crisis, the 1990 Asian crisis, the Russian crisis, Argentinian crisis, etc., where markets have crashed so suddenly, so quickly, that for writing put options even deep out of the money, or even with very low strike prices, a put option will come in the money when the spot goes below the strike. So if the spot is 100 and the strike is 10, will this option be exercised? Or is it likely to be exercised? Answer is no, it's deep out of the money. But the price of this option is still slightly higher than what the Black-Scholes-Merton model would have given. The reason is that market participants fear that this 100 to 9 can actually happen. Stock can crash massively because they've seen that happen in the past. So they won't just write that option and give you for free or give you for a very low price. They're charging a slightly higher for this risk of a crash. Our second reason attributed is leverage. Leverage is the market value of equity divided by the market value of debt. Now, as equity price goes down, as the spot price goes from 100 to 50, the market value of equity is also going down. The market value of debt will remain the same, more or less, because the debt still has to be repaid. So you understand that as the stock price is going down, the risk is further increasing or further compounding. The leverage of the company is further increasing. Hence, the probability of further down moves and further problems in the company can increase. Hence, this crash again can happen. So, market participants are fearful of this fact, and hence lower strike prices, indicating deep out of the money put options, generally have higher implied volatility as compared to higher strike prices or in the money put options. So equity options have seen to exhibit more of a smirk. Currency options have seen more exhibit a smile. That is, extreme movements either ways are presumed to be more likely in the case of currencies, and crashes are presumed to be more likely in the case of equities. Various alternative methods have been used to study implied volatility. So, implied volatility can be calculated at any strike price. So, you can replace the strike price with the strike price divided by the stock price. So, K by S can be used as the K. So, making the option again deep in the money or deep out of the money, and then trying to see what the implied volatility comes out to be. Replacing the strike price with the strike price divided by the forward price. Replacing the strike price with the delta of the option are all some strategies that we have used to calculate the implied volatility at these strike prices, and then see how the implied volatility differs from that of an at-the-money option. You don't need to know the details of this, they're very important, but just know that there are various methods that have been used, that implied volatilities have been calculated at different strike prices to see how the implied volatilities behave. An important concept is that of the volatility term structures. So the volatility smile and the volatility smirk that we depicted basically plotted the implied volatility with the strike price, or with the moneyness, how in the money or out of the money is the option. Implied volatilities have often also been seen to vary with time to maturity. So we can see, or we have seen, that deep, or rather longer term options have higher implied volatility, shorter term options have lower implied volatility, so on and so forth. So volatility term structure would be the variation of implied volatility with time to maturity. And there is no consistent pattern that we have seen in this case, like with the moneyness, like with currency, deep in the money, deep out of the money for currencies, or deep out of the money puts for equities. But again, volatility term structures have also been studied. That is, how does the implied volatility vary with time to maturity of the option or time to expiration. Volatility surfaces can also be plotted. That is, how does the implied vol vary with the time to maturity and the strike price both. So we've seen, for instance, that deep in the money short-term options have a higher implied volatility than deep out of the money long-term options, so on and so forth. So this is a 3D graph. So we can study volatility term structures, how volatility, implied volatility varies with time, and also together, that is how implied volatility varies with a particular level of strike price and time to maturity and another level of strike price and time to maturity. And then again we can do more analysis and try to see how the pricing of options is actually done and how it differs from the Black-Scholes-Merton pricing or the log normal pricing. Finally, please understand that implied volatility will affect our calculation of the option Greeks. We studied the Greeks at FRM part 1, delta, vega, theta, etc. So, if the implied volatility is constant, that is, it's constant, there's no real smile, then the option Greeks will be correctly calculated as we have been calculating up till now, all the formula that we studied at FRM part 1. If volatility smiles are not flat, there is a smile or a smirk, then we require the use of specialized functions to correctly calculate option Greeks. Details of these functions you don't have, but just know that implied volatility smiles will affect option Greeks. That is, if the implied volatility structure is not flat, then option Greeks may not be correctly calculated. Finally, we want to end with introducing the phenomena of price jumps. So, many a times we've seen volatility frowns instead of smiles. This is relatively rare. Mostly we see these frowns, but sometimes we've seen that the prices of at-the-money options have suddenly shot up. For whatever reason, could be some technical reason, some expectation, some news flow in the stock, etc. Which is why we are seeing that at-the-money options have suddenly increased in price, whereas the out-of-the-money and in-the-money options haven't yet changed so much. So we may at times even see an implied volatility frown instead of a smile, because of price jumps. So that was about the review on volatility smiles. Just go through the video once again and just remember the various concepts. Not very mathematical, this topic, so it's good if it comes on the exam. It should be relatively easy to score on this one. Thanks a lot, and see you next time.